The money we use every day looks simple: a balance in a bank account, a payment with a card, a transfer on a phone. But behind the money you use every day, a quiet battle over debt is unfolding. In earlier episodes, we explored how modern monetary systems create currency. Central banks issue currency and operate the settlement layer. But most of the currency circulating in the economy is created by commercial banks when they extend credit to households and businesses, a process we described as money being created by lending it into existence. That means much of the currency we use every day is built on private credit financing the real economy. So the currency we use is debt-based and created through credit, and that credit usually comes from two different sources of debt. On one side is commercial bank credit, which finances homes, businesses, and investment. On the other side is sovereign debt, issued by governments to finance public spending. For most of the modern era, circulating currency has been built largely on the first of these foundations, commercial bank credit. But today, a different type of digital currency is emerging, one that is not created through commercial bank lending at all. Instead, it is issued by private networks and backed largely by government debt held in reserve. These instruments are known as stablecoins. Stablecoins are digital tokens designed to maintain a stable value relative to existing currencies, such as the US dollar or the euro. In practice, this means that one digital token is meant to represent $1 or €1. To maintain that stability, the issuer holds financial assets in reserve. When users acquire stablecoins, the issuer receives traditional currency in return and invests those funds in assets considered safe and liquid, often bank deposits and short-term government bonds. So behind these digital tokens sits a pool of financial assets intended to support their value. At first glance, this may look like a simple payment technology, but it also means something important. As stablecoins grow, the reserves backing them must grow as well. And when those reserves are invested largely in government bonds, the expansion of stablecoins can quietly increase demand for sovereign debt. To understand why stablecoins have grown so quickly, it helps to look at where they are used. One early driver came from digital asset markets. Cryptocurrency exchanges needed a way to move value quickly between platforms without relying on traditional banking systems. Stablecoins offered a convenient solution, allowing traders to move digital dollars or euros across networks almost instantly. But stablecoins soon spread beyond trading platforms. In many parts of the world, people live in economies where local currencies can lose value quickly due to inflation or economic instability. In those environments, access to stable foreign currency can be limited. Stablecoins began offering something new, a way to hold and transfer digital dollars or euros using only a smartphone and an internet connection. They also allow relatively fast and inexpensive transfers across digital networks compared with traditional international banking systems. And in some countries, they can operate outside parts of the local financial system, allowing users to move value digitally even when domestic banking systems are tightly regulated. For millions of users around the world, stablecoins therefore function as a convenient form of digital currency. But behind that convenience sits an important structural effect. As stablecoins circulate globally, the reserves backing them must expand, and those reserves are often invested in government bonds. This connects stablecoins to a much larger story about sovereign debt. In earlier episodes, we explored how governments accumulate large amounts of debt over time. Governments borrow to finance spending, respond to crises, and refinance existing obligations. That means they depend on steady demand for their bonds. Traditionally, that demand comes from several sources: domestic investors such as pension funds and insurance companies, commercial banks that hold government bonds as part of their balance sheets, and central banks that purchase sovereign debt through monetary policy operations. But as debt levels rise across many advanced economies, maintaining that demand becomes increasingly important. If the supply of government bonds grows faster than demand, borrowing costs can rise. And because debt levels are already large, even small increases in interest rates can cause government debt servicing costs to grow rapidly. For highly indebted governments, maintaining strong demand for their bonds therefore becomes critical. Financial systems often evolve mechanisms that help absorb large quantities of sovereign debt. In earlier episodes, we discussed one such mechanism, financial repression, where regulations steer domestic savings toward government bonds. Stablecoins may represent a different type of channel, not through regulation, but through digital financial infrastructure. As stablecoins grow, their reserves grow as well. And if those reserves are invested largely in sovereign bonds, the expansion of stablecoins can gradually increase demand for government debt. But unlike traditional financial repression, this demand does not come only from domestic institutions. Stablecoins circulate across global digital networks and can be used by individuals, traders, and businesses around the world. In that sense, stablecoins may be doing something unusual. They allow government debt to circulate indirectly as digital currency within global payment systems. This is where the quiet battle over debt becomes clearer. On one side sits commercial bank credit, which finances businesses and economic activity. On the other sits sovereign debt, which finances governments. Stablecoins may be shifting part of the monetary infrastructure toward the second model. At the same time, many central banks are exploring another path toward digital money. Instead of private networks issuing digital tokens backed by reserves, governments could issue digital currency directly. These initiatives are known as central bank digital currencies, or CBDCs, which we explored in the previous episode. CBDCs represent one possible architecture for digital money, one in which the central bank operates the monetary infrastructure directly. Stablecoins represent another path, where private networks issue digital tokens while relying on sovereign assets to support their value. Both models point toward a broader shift. Money is becoming increasingly digital and embedded in new financial infrastructures. But the architecture of that system is still evolving. Stablecoins may therefore represent something more than a payment technology. They may be part of a deeper transformation in how currency circulates and how sovereign debt is absorbed within the global financial system. And that brings us back to the question we started with. Behind the money we use every day, a quiet competition over debt may be unfolding. Which form of debt will ultimately stand behind the currency of the digital age, private credit created by commercial banks, or sovereign bonds issued by governments? Understanding that question may reveal more about the future of money than any single technology. Stablecoins is part of TNBC Explainers Module 3. Economy, Money, and Financial Power. Explore the TNBC Explainers course via the YouTube course list, or visit thenextbigcycle.world for the full course overview and background. This is the next big cycle. TNBC Explainers, your guide to understanding the systems shaping the world around you. TNBC Explainers is a growing YouTube course. New concepts are added over time,